Hi there. So in the last couple of months, there have been a lot of companies whose stock price dropped significantly, and one of them is Teleperformance. Now, are these companies value traps, meaning are they actually bad companies, or is there any intrinsic value there? I think, spoiler alert, I think Teleperformance is a great company. I think it's significantly undervalued, and the market has overreacted. So what I'm doing is I'm buying the company. If you wanna see why I'm doing that, why the share price dropped, please look at this video, and that's it. Also, the camera is gonna be shaking a bit since I have my laptop on my lap. Yeah, so let's start. Um, so what does the we're gonna look at what the company actually does, why the price dropped, the valuation as I see it based on the metrics, the discounted cash flow and all of that. And in the final slide, I'll show you my conclusion, my thesis. Uh, so the company is, despite being a mainstream investment discourse, is the global leader in outsourced customer experience management services. But what does that mean? Well, basically, this is a description of a company that operates primarily as an international call center. So this is one of those companies which when you have problems with a website or a program, collect call customer support, and that's basically the company. However, the services that Teleperformance provides to its clients extend far beyond the typical realm of call center operations. Its service palette includes care solutions, technical supports, acquisition services, digital solutions, debt collection services, translation, interpretation, even analytics. So anything you can think of. It employs over 400,000 individuals from 91 countries, operates in over 300 languages, and serves nearly 1,200 clients, ranging from massive corporations to smaller businesses. And this is a testament to its leading position. Over half of the company's workforce works from home, meaning remote, and this is a testament to its adaptability and robustness of the operational model. Now, what does it mean that they work remote? It's basically what it says. So if you work from home, that's basically the model of this company. I haven't seen a company like this having such a large market cap, being a market leader in so far since I've been valuing companies. And this is basically a company when your friend tells you he's working for a company and he's getting paid for it just for doing some simple tasks, straightforward tasks. So this is like, you would think this is a scam, right? But no. I did some research on the company. I went on their website and typed the careers, and you can click any country you'd like. You could Bolivia, Chile, Switzerland, Great Britain, whatever, and they have job opportunities. And actually, you have to speak the language. You need some basic competence, but then you can work either remote, or even at the headquarters. So the company is basically French. And what else I would say here? Ah, yeah, that the ticker, if you're gonna buy it, you should buy the native ticker. I think it's better in terms of liquidity. Liquidity basically means how fast you can buy and sell a stock. So the more there is liquidity, the faster you can sell your stock. So, okay, that's basically that. Now, let's look at the track record. Its track record is nothing short of impressive. It's stellar. Its consistency and reliability are such that for decades it has reliably improved its results across a variety of metrics. This includes positive trends in revenues, net income, equity, sales, and profitability metrics. So, all of the ROI, or investment capital, and so on. This consistency extends to its impressive response to the COVID-19 pandemic, which, despite presenting global challenges, led to a record revenue growth for Teleperformance. It reported a 14.6 year-over-year growth for the full year of 2022, an exceptional performance considering the overall business attrition caused by the COVID-19 pandemic. Attrition basically means how many employees left the company. So alongside this, the company reported a 15.8 growth in net profit and a 16.7 growth in dividends. So dividends, I think the actual dividend rate is around 2.6%, something like that. And also, I consider myself a dividend investor, meaning I invest in companies which have more or less stable high dividend rates, around 3 to 5%, and have been paying them consistently for the 100 years or whatever. And in the last couple of months, I shifted my focus, given that the country of residency, mine, is has higher tax rates. So now I'm looking more of growth companies. Uh, so I'm shifting my focus from dividend more to growth companies. And given that Teleperformance is 2.6%, it has a better uh, stock price opportunities. So why did the price drop? You may ask yourself. Well, despite its strength, Teleperformance experienced a 38% drop in stock value in a single day due to concerns about work conditions and content moderation in some of the company's offices and regions. While this drop raised eyebrows, it's crucial to remember that such setbacks are not unusual for companies operating on a global scale. Additionally, while the company's debt has been increasing due to mergers and acquisitions, the management has effectively strategized its expansion and mergers and acquisitions, leading to a well-balanced geographic business distribution. Don't forget, this is a global company, so and it's a giant. So Mayorel, I hope I'm not butchering the name, is another uh, a similar customer service company. It's based in US, and Teleperformance announced a merger acquisition. So it took a lot of debt and it took over the company. And this is what caused another uh, share drop in the last years. It recently proposed the acquisition of Mayorel, leading to another temporary drop in a share price. I mean temporary. I think it's gonna reverse soon enough. This is a not an uncommon occurrence in situations of substantial mergers and acquisitions activity. So if you're gonna keep buying companies just so you stay alive and you're gonna keep raising more debt, of course that's bad for the stock price. That's because it dropped. So I don't think it's actually something to worry about. Now let's look at the valuation. What's the company actually worth right now? Well, as you can see, it already has the one of the best rated um, remote agent programs, so and client satisfaction ratings, as you're gonna see later on. Its strategy extends beyond its core call center business, leading to significant growth in specialized services. This segment has generated over 1.2 billion in revenues, positioning the company as one of the most efficient businesses in the sector, which is crazy. This efficiency, coupled with its broad industry reach and high client satisfaction rating, further highlights Teleperformance's strong fundamentals. While the company's short-term rate of return might appear to underperform some of its peers, the long-term outlook shows an annual rate of return of over 20%. So even in volatile markets, Teleperformance maintains a double-digit return on investment capital while keeping its weighted average cost of capital, so WACC, under 5.5%. This ratio indicates a strong potential for value creation even under more challenging market conditions. So as such, despite some temporary setbacks, the current valuation of Teleperformance does not reflect its actual earnings potential and future growth prospects. In fact, a conservative target share price of 275 would still be a significantly below the average analyst target, leaving a lot of room for outperformance. So again, as you can see, the how diversified this conglomerate is crazy. You can see how, how the portfolio is compromised. You can see nothing exceeds more than 15-16%. So healthcare is the largest, it's 16%, but you never see this. Mostly the diversification, it it's one segment, at least 40%, something like that. So it's quite good. And also the peers, all of the peers, the competitors, such as Telus, Concentrix, Atento, Sykes, Mairel, which is now part of it, are all smaller in size. So this is like a in Slovenian terms, this is like a Google in terms of this is like a JP Morgan in terms of um, NLB or something like that. It's a big boy. So um, I also wanted to say that you could also compare it to perhaps what's it called? The company I forgot it. It's I don't remember right now. Maybe no, I forgot. Well, it doesn't matter. Let's see the thesis. So, in conclusion, Teleperformance's proven track record, efficient operations, diversified business portfolio, and its steady growth potential make it an attractive options for investors. Its company, it is a company that shows resilience in the face of adversity and is well positioned to capitalize on future growth opportunities. So, most analysts rate it as a buy. You could see that if you just Google it, you could see that most analysts are buy or maybe some hold. And what I'm saying here is conservative. So if we would look at the if it returns to the normal PE ratio, you could look at our in 3 years around 250% rate of return. So given that you invest 1,000 euros, you would get out uh, a lot more. So my conservative target, conservative, meaning there is little to no risk. There is some risk, but it's not a lot, is 275 euros a share. This is based on the SE ticker, so the French one, and this is 20% lower than the average analyst predictions. So I think this is a bargain. I am buying it, and yeah, that's basically it. I hope you. Oh, I just remembered the company here in this slide, where I mentioned. Yeah, you could compare it to Accenture, also the company, uh, in terms of services, and it's also outperforming Accenture. So just so I say that. Yeah, that's it. Thank you. If you have any questions, please let me know. This was just a short presentation. Another company that is also super qualitative is Neste. This is the one that produces cereals and food, and I'm gonna do probably a presentation on it soon enough. But it's not mm, undervalued as this one. And yeah. Oh, also, in my school, I was doing a Piotrowski test score. This is a value score that evaluates companies from the scale of 1 to 9, and the higher the score, the better the company. And I created a program in Python and used the Piotrowski score for this teleperformance, and it just so happens it got a F score of 7, which is great. So another indicator that this is a value stock, and it's a, I don't know how long is it gonna be for sale in that sense. So that's it. Thank you for listening, and see you later.